There are a lot of advisors and loud financial voices out there
Run your
who are
freaking
still
mouth.
promoting the use of mutual funds in your investment portfolio. In this video, we're going to break down and explore just how expensive they really are.
Shut up.
And the impact that mutual fund and exchange-traded fund fees have on your portfolio's long-term performance.
Seriously.
Coming up. Hey there. If this is your first time here, my name is Steven Spicer, and it's my goal to help you invest smarter. In the last video, we explored the significant impact advisory fees can have on your bottom line. It was pretty alarming, right? Where just due to an industry average advisory fee of just 1%, after 30 years, your account was only 44% your initial projections. If you missed it, you should check it out. And if you're regularly missing out on the value we're putting together to help you invest smarter, well, you should probably make sure that you're subscribed and that you have those notifications on. Now, let's take this honest exploration that we've been undergoing over the last couple of weeks of actual returns that you can realize in the market one step further. Think about where these broker-dealers and RIAs, registered investment advisory firms, are ultimately investing. Most will invest in mutual funds and exchange-traded funds, ETFs, both of which bring with them yet another layer of fees, the former much more significant than the latter. Even when your firm invests some of your money in individual stocks, thus not incurring a fund's fees, they tend to find a way to hurt your bottom line regardless. Edward Jones, for example, will charge you a roughly 2% commission, and Northwestern Mutual just has a flat and relatively high trading commission that is automatically pulled from your account every time your rep puts you in and then again out of an individual stock position, which is even more destructive on smaller accounts. But back to the funds. Let's start with mutual funds. Mutual funds are investment programs where investors are essentially pooling their money in order to allow money managers to diversify their holdings. Vanguard, BlackRock, Fidelity, and American funds are by far the largest mutual fund families in the world, each boasting more than $1.5 trillion in assets. While BlackRock is contending with Vanguard on the low fees front, don't worry, they'll come up again later, Fidelity and American funds continue to rock some pretty hefty charges. Northwestern Mutual's go-to fund provider is the old guard behemoth American funds. And part of the reason for this is because with these higher fees that they're extracting from investors, American funds is able to offer a larger cut to the middleman, e.g. Northwestern Corporate and the individual agents, their sales reps. However, with Vanguard, for example, and its lower fees, there isn't as much to share. Thus, during my Northwestern tenure, I became very familiar with the American fund's fee structure. Advisors sold mutual funds often have different options for how you'd like to structure their fees. These different options are called share classes. A shares will charge a large front load fee, and then they have a lower ongoing fee for marketing and operations expenses. B shares, not very common, charge a back end load and come with higher ongoing expenses, while C shares are considered to have a level load. There's no front-end charge. They generally have a much lower back-end fee, and their operating expenses are relatively high, higher than the other two. A and C shares tend to be the most common among retail investors. That's the industry term for the non-professional investor. Let's start by exploring the latter with its level annual fees. Quick note, if doing this digging yourself, use caution to look for the total net annual expense ratios, not just the management fees. The total expense ratio is always larger than the management fee alone, even if that difference is, for some funds, negligible. Now, American Fund's largest fund is the Growth Fund of America, AGTHX, with $115 billion in assets. The net annual expense ratio for C shares is 1.4%. Obviously, another 1.4% hit to our sum, that sum that we've been building up over the last couple of videos, would be significantly impactful, as it would be for your long-term returns if that's how you're invested. There are some advisors, even some that I know personally, who will simply plug you into a portfolio of American funds and charge you their own significant advisory fee on top. A 1.x% advisory fee plus a 1.4% fund fee is crazy destructive to your bottom line. But to be fair, I don't think most do that. Most of the advisors with those larger firms utilize a mix of mutual and exchange traded funds. An ETF is a security derived from a collection of stocks, usually, that often track an underlying index, like the S&P 500, Dow Jones Industrial Average. Because the fund's underlying holdings are based on whatever its respective index is doing, rather than rigorous research from a team of expensive professionals, the expense ratios are considerably less, as low as just 0.02%. I think there was one for a brief stint with a negative fee, but pretty sure that just shut down. Who'd have thought? With that mix of mutual and exchange traded funds, the average additional fee incurred by those larger advisory firms, the RIAs and broker-dealers cited in our last video, is around 0.4%. Some quite a bit more, some even less. So that's an additional ongoing fee and should be considered in your expectations. Even though there are several examples of large players in this space, like Ameriprise Financial, who incur higher fund fees on their clients' hundreds of billions of dollars that they have under management, will stick with that 0.4% average and will assume a low advisory fee of just 1%. Let's refer back to that same example we used in our last couple of videos. Remember that $100 that invested in 1926 that would have been projected to grow to $4.6 million with the original 12.1% assumption? That's the simple average from the S&P 500 over that time, but that in reality turned out to be less than $1 million before factoring in any fees? Well, after accounting for those advisory and fund fees, your since 1926 number would actually have only grown to $254,000. That's 5.5% of your original expectation. Your 10-year return would be 73% of its projected value. Your 20-year return would be 54% of its projected value, and your 30-year return would be all the way down to 40% of its projected value. Now remember that the advisory and fund fee assumptions that we're using here are average. That means there are tens of millions of investors out there who, even if everything goes as planned, as in the market actually does what it did in the past, they'll be facing an even harsher reality than those we just considered. Know where you fit in and adjust your expectations accordingly. Now, let's explore the differing impact that A shares should have on your return expectations. A shares, going back to the mutual fund example from earlier, for the Growth Fund of America from American Funds, those come with a hefty 5.75% front load fee. The ongoing fee is then less, and it would be 0.65% in this case. This equation means that you're immediately down almost 6% on day one of your contribution into this fund. A case could easily be made, however, to mathematically show you how much better off you'd be than with its C-share counterpart over the long run for making that initial sacrifice. Here's an actual breakdown of how a $10,000 investment would look after 10, 20, and 30 years, given the actual historical return of the market. I've accounted for no advisory fees here, just the upfront 5.75% plus the ongoing 0.65% fees for A shares and the annual 1.4% fee for C shares. And for additional emphasis, I've placed them both beside the 12% historical market average, or the 12% reality, as Dave Ramsey calls it.
Stupid people.
With historical market returns, it would take just under 9 years for the growth of that $10,000 invested into A shares to pass its respective value in C shares. You could see how easy it would be to convince a young person trying to do the right thing and save for the long haul to splurge for the A shares front load. Really, it depends on you and what your plans are. Sure, you're committed to investing for retirement, which may be a decade or 2 or 3 from now. But are you that committed to this particular fund? because if you change your mind in the future, it's going to cost you dearly. Think back on Dave Ramsey's reassurances, as discussed in this video, about your ability to realize 12% of the market. In that same 12% reality article, he encourages you to invest in mutual funds, ideally front-loaded with an expense ratio, an ongoing expense ratio, just under 1%, he says. And to use one of his experts. We'll definitely be talking more about them in the future. When you factor in all of this, actual instead of average returns as discussed in this video, advisory fees, this video, and fund expense ratios, which we're talking about right now, you will be hard-pressed to realize even an 8% annualized return under the historical assumptions these market peddlers love to cite. The two personalities mentioned in this video and my last are major influences of everyday Americans just trying to save for their retirement goals. Dave Ramsey, with his more than 14 million weekly listeners and more than 11 million books sold, and Rick Edelman, with his firm's more than 1.2 million clients. Let's look at what those everyday Americans saving for retirement would have actually realized over the last 10, 20, or 30 years compared to the expectations laid out by these men and so many others. For Dave, we're assuming here a conservative advisory fee of 1% and a more than acceptable by his standards annual fund fee of 0.65% with a 5.75% front load, the actual fees of American Fund's most popular fund. For Rick, we're assuming that 1.75% advisory fee that his firm charges to accounts under $400,000 and the low end of his firm's average underlying fund expenses, 0.3%. Assuming actual geometric average historical market returns and a $5,000 annual contribution, here is how far off your reality would be from that 12% expectation they've both set. At 12%, after 30 years, an account would have grown to more than $1.3 million. Using Ramsey's guideline assumptions and recommendations, you'd have less than half that. With Edelman's, you'd have even less, with just over $600,000. A far cry from Dave's real 12%, despite all his comforting words of reassurance along the way, and Edelman's conservative 12%, with that 14% expectation seated in the back of many readers' minds. Now, real quick, it may sound at this point as though I am simply advocating a more automated, think anti-fee approach. After all, for most of these advisors, really, sadly, almost every single one of them, you're paying all these fees for them to just plug you into that same old stock and bond only buy and hold approach that you could find somewhere else for way less. Sure, some of them might have their own little twist, most don't, or claims of added value, but if you buy into that stock and bond strategy, why wouldn't you just go with one of the far less expensive alternatives who will just plug you right in at a fraction of the ongoing fees and no upfront fees? You have your broker-dealer options like Vanguard or Charles Schwab with their negligible advisory fees, 0.3% and 0.28% respectively. Or there are the robo-advisors, Betterment and Wealthfront, both at 0.25% at the time of this reporting. This is, in fact, not the route I would recommend, but for reasons we'll cover in due time. Sorry for the cliffhanger, but there's a lot to unfold here. We'll explore all of this in greater detail later. The value of the advisor expertise for which you're paying, the validity of the buy and hold stock and bond only strategy, and so on. But with all of this talk of fees, these low-cost players absolutely deserve a mention here, even if you still can't count on a 12% return. Besides, I'm sure many of you were screaming about these low-fee alternatives already. I just wanted to assure you I'm not ignoring them. To that end, I hope you'll subscribe and hit that notification bell so that you don't miss any of this as I unravel it. Okay, fine. So back to the main theme here of trying to determine what returns should you actually expect from the market. We just use this adjusted historical return figure to manage your expectations then, right? We came down from the simple average of 12.1% to the real average of 10.2%. And then after accounting for average fees, the real historical return of the market dropped to 8.7%. That's it. That's the figure we should use now, right? Easy enough. So we just need to save more or prepare for less. Unfortunately, it's still not that easy. The reality is significantly worse. But it's too much for one video. Sorry, I know that's a terrible cliffhanger. So many cliffhangers, but it's the truth. If you'd like to learn more from me and my team, check out our community at community.spicercapital.com. Until next week, take care.
Shut up. Seriously.